After crude oil prices rose from a 7-week low and after that oil producer rally that we were just talking about with Zara, Doug Sandler, Chief Equity Officer at Riverfront Investment Group, joins us now to discuss the question of what investors should and shouldn't do as oil prices remain volatile. He joins us from Richmond, Virginia. Doug, thanks for joining us. Let me first get your take on where we see oil prices going. I mean, do you just contend that they're going to be volatile, or do you think we're going to see momentum in one direction or the other?
I think the answer is probably both. I think they're going to be volatile, and you're going to see, spurts of momentum either direction. The guess of where oil goes, I guess first the dollar. I think there's a secular trend that the dollar is going to be weak, and that's going to be multi-year, and that's probably a good thing for oil prices in dollar terms. But, where it's going to be 6 months from now, I think we've proven just in the last 2 years that no analyst can predict that. It's a guess. The opportunity, I think, really
it was easier at $30 a barrel, wasn't it?
Well, I mean, we had 3 months ago we had people telling you it was going to go back to 20, and 12 months ago people said it was going to go to 200. So I think trying to predict oil prices is probably one of the most difficult things out there. Yesterday was a good tip-off as to what would happen today, though. You saw oil go down $2 or $3 yesterday, yet oil stocks were moderately unchanged, or even some were up. And I think that gave you a good tip that today was going to be a good day for oil stocks. Our view is the opportunity, if we can find companies that either don't trade that closely linked to oil prices, that's one opportunity. And I think the big integrateds are an area to play. So a lot of retail investors say, what do I do about oil going from $72 to $60? How should I adjust my portfolio? Our view is the integrateds are probably a really good fit there. They didn't participate in the energy rally that you had over the last 3 months. You got stocks at somewhere between 9 and 10 times earnings, which is pretty cheap. And on average, I'm getting about 4% dividend yield with about 15% dividend growth. I think that's attractive. And the one problem that the integrateds tend to have is they don't own enough production, or they're not restoring the oil that they're pulling out of the ground. And the magic cure-all for that is to have a couple of competitors get into trouble, and they'll buy them out. And that's the reason why we have Chevron, Texaco, and ExxonMobil, and ConocoPhillips, is because the people with the good balance sheets took advantage of those pullbacks in energy prices.
Well, and of course their margins look better, right, on the refining side when we see these prices come down.
Right. It's a more vertically integrated business, and there's you can make money not just one part of the supply stream.
What about the E&Ps? I mean, is it a problem for them when we see prices come down like this?
The E&Ps are the most closely linked to the commodity prices, so you see oil or gas go down and it's bad for the E&Ps. The only good thing about it is E&Ps investors know that, so they tend to get way in front of a trend and often take a trend to its extreme. So we saw E&P companies drop significantly over the last couple of weeks here, in fact giving back all the relative gains year to date. I think that's probably an opportunity, and at least you can say if oil prices keep going down, unless we go back below that $40 level, most E&Ps have probably already discounted it.
Does that mean we see consolidation, though? I mean, the drop that you've seen there, consolidation in the E&Ps as well going forward?
Well, they did have a window back, 2 months ago where they were able to raise money, and, if you didn't have that period where a lot of these folks could have rebuilt their balance sheets, I'd say the consolidation period will be quicker. You did have a window where people got a little bit more fuel in the tank to go a little longer if the macro trends remain lousy. But ultimately, there'll be consolidation there, and you got people like Exxon with $30-odd billion sitting on their balance sheet that I think are probably just salivating at the chance.
Let me ask what you think about demand. I mean, getting back to the fundamental pressures on the price, do you see demand possibly dropping further from here? Because it seems like it's already fallen a fair amount in the U.S.
Well, I think demand is two things. I mean, natural gas is a U.S. used energy source. So I think in the U.S. the feeling is we're going to muddle along. The economy may have bottomed, but it's probably not going to be fast growth. So the prospect for natural gas probably isn't too great, and that's why the commodity's trading so low. Oil is a international commodity traded on a global stage. And I think one of the true growth areas of the market, and you were asking Tony Dwyer earlier, where does growth come from? In our view, it's the emerging markets, and oil will be used there. So what we don't use in the U.S. may very well be more than made up for in China, India, and the rest of the emerging markets.
And let me finally ask about the financial play here. I mean, a lot of people have been starting to branch out into other commodities as a hedge against inflation, a hedge against the dollar, and we've seen that obviously happen in oil. Is this a trend that continues, that picks up steam, or is it just a fad?
No, our view is that, you know, a lower U.S. dollar on a secular basis is something that most investors haven't protected themselves against. Our portfolios that we run have, you know, roughly anywhere between 6 to 10% commodity exposure, and that would include copper, agriculture, oil and gas, and precious metals like gold.
All right. Hey, thanks so much for joining us. Doug Sandler there from Riverfront Investment Group.